The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome back to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing, Guy?
Pretty good. Hope everyone's Saturday is going well so far.
Oh, yeah. It's a couple days after Thanksgiving. I hope I'm about to explode for a few days, right?
I know I've got a notch or two let out on my belt.
We've been off the air for, 2 weeks in a row because of the UT game?
UT.
So hopefully it won't preempt this one. You'll hear this one next week.
And the questions will be new and material will be new. So
right. The holidays are upon us. You know, there's a lot of different gift-giving things you can give financially. We'll talk about that a little bit. Remember, the lifetime exemptions for giving are $14,000 a year. And that goes against you actually give $14,000 a year to anyone, right?
All right.
But the most you can give to any one person without them having to pay tax on the gift is $5 million lifetime?
Yeah, 5.4, and also that 14 million
14,000.
Yeah, 14,000. Did I say 14 million?
Yeah.
Holy cow! Well, you got Trump in the office now.
That's right.
He's getting rid of the inheritance. No, that 14,000 is per capita or per person. So per family, both the husband and the wife could give 14,000 each to a child or whomever, for a total of 28,000.
Right. You know, a lot of people don't realize you just can't give money to someone without them paying tax on it.
Someone's got, and it's already been taxed, right?
Oh, yeah.
But we want tax again.
It's kind of like the death tax. You pay taxes, and when you pass to kids, they pay taxes again.
And you thought dying was free. No.
Trump has talked about getting rid of the estate tax or death tax.
Capital gains tax.
This is going to be tough because I saw the infrastructure spending bills that he was proposing or whatever. I don't know how he's going to pay for it all.
Well, they're thinking that the economy will stimulate enough, but I don't know what the numbers are. You have any clue if how much the country generates annually on estate tax? It's got to be a large number, doesn't it?
Oh, yeah. It was a lot more when the estate tax was at $1 million.
Oh, yeah. That's right.
Now it's, $10 million between two people and all that. Was it 10 million, almost 11 million between two people when you want to give, after you die and you give money to your heirs. Remember, you pay tax on the money, you pay tax and growth on the money, and then when you die, your kids will pay tax on their gift. Anything above 11 million, which for most of us is not going to apply anyway. So it's not, that's for your wealthier people, you need to really do some estate planning.
And if it does apply to you, Victor, what'd your dad used to call that?
That's called a high-class problem.
That's right.
That's right. You can also give to, 529 plans. 529 is for college, right? If they don't go to college, you can pass it on to any other child you want, grandchild, child, niece, cousin, whatever. If you take that money out, the benefits of a 529 plan are the money grows tax deferred, and if used for a qualified college, expense, and then it comes out tax free. You can put more than the, 14,000. You put 5 years up front, $70,000 up front. It used to be 50 when they first came out with it. So you can put $70,000 up front to help with a grandchild or anything else, and they don't have to pay tax on that gift. You can put more than that if you're actually paying directly to the college, but doesn't really give you the benefit of the 529 because there's nothing deferred to grow tax-free.
Doesn't have the time to grow tax-free. That's right.
So the best time to do them, obviously, is when your kids or grandkids are younger. I understand that life happens. It's tough for parents sometimes, but sometimes the grandparents can kick in. And like I said, you put in $70,000 now. If it has any growth at all, it might be quite a bit of money later on, tax-free for, some tuition or whatever. And if I remember correctly, you can use other college expenses like room and board and all that kind of stuff as well.
Medical expenses paid to the provider.
Right. Some other things you can't, like education IRAs. I don't think you can use anything but tuition and books and things.
And it also always talks about you can give the $14,000 for a down payment on a home and that sort of thing. You can give more, but it's not tax exempt or exclusion. It will trigger a taxable event. Somebody has to pay the tax again.
Right. Unless you give money to a charity.
There you go.
Right? There's several ways to give money to charities. Some people give cash, not bad. Some people will give stock.
Stocks.
Right. And what the stock is interesting is if you got a big gain on a block of stock, you're going to save all that taxes you would have had to pay if you sold it, right? You give it to the charity. You're going to have a write-off for the full amount. Instead of a tax bill, you get a write-off for the full amount, right?
They get the higher basis, but it doesn't matter, does it?
That's right. The charity doesn't pay taxes. And so you can give cash. You can give stock. Also, a lot of people in their estate planning will give life insurance proceeds. Okay? These charitable organizations don't care. They got tons of people that endow money to them. But think about it. Let's say you had $100,000 to give to charity. Well, $100,000, if say you're 40 years old, 50 years old, or whatever, that's pretty good. But what if you gave them a $500,000 life insurance policy with them as beneficiaries? Well, that might be better, or $1 million, whatever the case may be. You might get your name on a plaque, giving it to your alma mater, but you might get a wing if you're giving up in life insurance proceeds.
But, charity's a lot like your children sometimes when they inherit something, let's say like a life insurance policy that has a cash value but hasn't matured yet. They don't necessarily wait for it to mature at all times. They may take the cash and go.
Oh,
but,
I know. That's the one thing I don't like about stretch IRAs.
Yeah.
Stretch IRAs they'll show you, an advisor will show you, okay, you got a $400,000 IRA. We can turn that with a stretch into $4 million in payments to your heirs. All sounds great. They're assuming some interest rates and assuming that one of those relatives all the way down, because that's going on generation to generation.
That's right.
One of those relatives isn't going to cash it out, which they always have access to it and they can always cash it out. And the fact is 99% of all inheritance is spent within 18 months.
I believe that.
99%.
Hey, if you don't mind, I'd like to revisit the stock gifting a little bit. Obvious, and I'm going to restate the obvious. I'm sure you understand, but depending on what your basis is in the stock that you're giving charity, obviously, if you're upside down, if it's not worth what you paid, you want to get the loss yourself and probably give the cash. But if you've got a lot of profit in it, it's good to give to the charity. You get the write-off. They get the stepped-up basis, but it doesn't matter to them. But a reason I mention that is you may want to gift it to children. Why would you want to give them, and they would get it at the higher basis? Well, what you could do with that, you could use that to have the family, whether it's you or the children, it's usually the children, with the lower tax bracket, pay the taxes on the stock. So it's a helpful hand there. So depending on what you owe, who's in the highest bracket, you can also give stock to the kids, certainly, if it may help your tax situation. We are not tax professionals here, but we know a little bit about taxes.
I know how to invest money.
Right.
Taxes, I just pay a lot of them. I know that.
Well, that's because you're going to have to figure it out again. New administration's coming in.
That's right.
Taxes are supposed to be lowered, but depending on where you are, they may not be lowered, right?
Yeah, the one thing I saw out of the Trump tax plan was there's going to be 3 tax brackets instead of 7.
Right.
It's a weird thing for people that in the higher tax brackets, over 400-something thousand a year. It's obviously a tax break for them. It's somewhere in between though, because it's going to go into the 33% bracket earlier than it did before. So those of you in the say 150 to 400, you might pay more.
Right.
And so
because you pay 33 for a
right.
longer period of time.
You make over 600-700, I think it starts evening out and then starts saving you money. So people that make many millions, all my multitudes of listeners out there that make many millions, you're going to get a hell of a tax break.
So the goal is to get above 600 or 700 a year, correct?
That's right. Oh, just ask your boss. I'm sure he'll accommodate. Let's talk about risk tolerance for a minute. I looked at another risk tolerance questionnaire. We're always looking at different ones because really when you do any investing whatsoever, you need to really determine your risk tolerance. And any fiduciary has to determine your risk tolerance before they can give you any kind of advice. And on the stock side, obviously, we're fiduciaries. But there's different ways to if they started asking people different ways to determine their risk tolerance. It's amazing if you put percentages on there, people will always check a higher risk tolerance for some reason. In other words, Can you withstand to get a 15% gain? Could stand the possibility of a 15% loss? And a lot of people say sure. But if you put it in dollar amounts,
it's $150,000 on $1 million.
That's right.
Are you comfortable with your account going down $150,000?
That's right. And
no.
They say, no, what they'll do is they'll couch it a different way. What if we had a financial crisis like we did in 2008? Are you okay with it going down 500,000 on your million? And invariably all of them say no, right? Even though if you put percentages out there, they would say more. So think of everything on a risk tolerance of your risk tolerance, not in percentages, but in actual dollars. How many dollars are you willing to risk? Because what you'll find is most people will tell you they're more risk tolerant than they really are. Like the best thing that can happen is I'm going to make 15% a year, double digits for the rest of my life. What's the worst thing? Losing $1. Well, they don't jive. We'll talk more about that after the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. All right, that first segment lacked a little energy, guy.
So we need to. You're saying we need to pick it up?
I bored myself to death.
I don't know that we quite. Go ahead.
I said I don't know what to do about it.
It's all that tryptophan from that turkey you had Thursday. It's still in your belly. Hey, we were talking about the risk tolerance before we went to break, and I know you weren't quite through with it either. But I wanted to add, I was listening to Hannity the other evening, and he was talking with Maria Bartiromo on stocks and things and investments. One of the statements he made was he said he's not really a stock guy. So whether you are or you aren't, obviously you've heard us. We use exchange traded funds for inflation hedge, for the market to take advantage of that, because we certainly believe some of your funds should be there. We use fixed annuities to create a pension. You'll hear us both talk about whether you want to have a guaranteed retirement or a non-guaranteed retirement, which is why we use a combination. But where I'm going with this, Hannity made an interesting comment. Again, it's one of those things we all know, but when you hear it again, it's, that's right. And his comment was this, and he started by saying he wasn't a real big stock guy, but he saw the value. But he went on to say, if you're within 10 years of needing that money, of needing to use that money, it shouldn't be in the stock market. And I think that's a pretty fair statement. Now, if you have a complete plan, you hear us talk about our financial analysis, which we love, shows you where you'll be, when you'll be there. It allows you to tweak it, do some different things, see what your taxes are in retirement, your Social Security, and all of that. But if you've got all of that taken care of and you've got the right amounts in each pocket, then it's less important. But the money you need specifically, and if it's somewhere where it's going to provide an income for you, a lifetime pension, then it's in a good place. But again, all that to say this, if you need the money, if you need it within 10 years, and that's the amount you need, don't take risks with it.
It plays into our philosophy, really. You know, our philosophy has always been and will always be, at least have your hard expenses paid by an income stream. The only reason we're talking about annuities at this point is annuities pay more income per dollar than anything going right now.
And that could change.
And so that allows you to put the least amount into your income-producing bucket. You could do it with stocks or CDs or whatever. It's just going to take a lot more because dividends on stocks are a lot lower than annuity payments. So are
you want to talk about
CDs,
bond yields?
Bonds, they're all much lower. So it allows you to put in a smaller amount of money. Remember, your most restrictive part is going to be your income producing, whether you use a bond or an annuity or whatever. Like to get any kind of yield, you got to go at least a 10-year bond, right? And they're only paying to pay 2%. So if you buy an annuity, you might have penalties for a certain period of time. Don't buy the immediate annuities right now, the ones that just pay immediate income and get rid of your principal, because they're based on the lowest interest rates in history.
Yeah.
Once interest rates come up, they might be a viable option again. Right now, in my opinion, they're not really a viable option, even though I do see advisors on the newspaper, radio saying that that's the only kind of annuity you should look at. But I can't give up my assets forever.
That's right.
If I die, I want somebody to get the balance of the thing, right? I don't want to go lock into zero growth forever either. So there's things like that makes it where I cannot do one of those, just a longevity annuity or an immediate annuity.
And right now, again, I'm going to harp on it because we really believe in it. When we talk about having a guaranteed or a non-guaranteed annuity, it's really important. You have to be careful. And I think, Victor, especially now, you have to be very careful who you listen to. 3 weeks ago, everyone was saying if Trump got elected, in fact, Mark Cuban was taking out hedges, shorting the market because it was going to tank, said he was going to make all of this money. Well, apparently at this point, they're wrong. The market's looking good. It's embracing maybe higher interest rates. It's kind of factored in. It's embracing tax cuts. It's embracing perhaps an economic stimulus. So you're going to hear a lot of that. And they're going to, you're going to hear people maybe taking options out on the market, doing futures on the market. It's a guarantee. Next 18 months are going to be wonderful. Don't believe that either. That's why if you have a plan, you don't have to listen to all this minutia from both sides, and you just stay the course.
I just look at long-term numbers. The market's overvalued. We have too high of a PE ratio.
Bubble.
Hasn't gone down in 8 years. All of those issues, they got a lot of headwinds to go against. Very difficult not to have a correction in the next year or two, regardless of who's in office.
And jobs in the economy and all
That's
of
right.
that.
So you got to be really careful with that. Just our philosophy is pay your bills with an income stream, at least your hard expenses. And that way you don't have to sell into a losing market if you got the other part in the stock market, which is fantastic for, future growth, inflation protection, all that kind of stuff. But having to sell into a down market destroys your retirement plan. It is amazing to me when I see about 95% of every retirement plan I've ever seen. I played 95, maybe 99%.
Oh.
All right. Are retirement plans based on nothing more than hope and wishes. It's not a plan. In other words, they'll do a Monte Carlo simulation. It gives you a 95% probability of success, given the mutual funds that you have currently. That tells you nothing. That means your entire retirement is based on the market making 8% a year until death. Now, if that's the kind of retirement plan you want, I'm okay. That's
your choice.
It's your money. I don't want a retirement plan based on the market making 8-9% for the rest of my life, or 5% for the rest of my life. Think about it. Market's only made 4.24% the last 15 years. All right. The last, 4 or 5 years it's gone up, but it went down so far in 2008. It just came off of that, right? Hasn't really made anything in 2 years. I know you hear making new highs all the time, but it's just barely up. If you look at it, the S&P was over 2,100 back in January of 2015. And now we're, end of November 2016. And so that's almost 2 years of no growth there. You start adding this stuff together, you're like, do I really want? Because remember, those Monte Carlo simulations are just based on long-term stuff. Well, we got a break coming up. Remember, if you'd like to take advantage of our no-cost, no-obligation retirement analysis or Social Security Optimizer, call us at 972-715-2424. Again, 972-715-2424, or go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show, folks. Remember, if you have any financial questions, like to take advantage of our no-cost, no-obligation retirement analysis, you could be 40, you could be 80. It'll still help you because it's the most detailed analysis that I've ever seen as far as retirement goes.
Nothing better than having good visibility.
That's right. If you'd like I said, we have a Social Security Optimizer. It shows you the real difference between taking Social Security at different ages, not just it goes up 8% a year and, innocuous numbers. It gives you your numbers. Here's what happens if you wait. Here's what happens with cost of living adjustments. Here's what happens with this and that. That's what you need to have. And that way it'll give you you can better make a decision on when to take Social Security.
It's one thing talking about this. We talk about planning on a 7% rate of return. And when you actually see it in black and white, it's almost life-changing. It makes a big difference. Maybe it's because I'm visual. But when you see it and you see the numbers, it's better than just hearing about it and talking about it.
Remember, call us at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. What you have is with these retirement plans that we're talking about, it's all, like I said, it's all based on, we'll base it on a stress test, because you don't want to say it. If my portfolio makes 25% a year, am I okay? Well, of course you are. That's not a test. That's not a retirement plan.
And your heirs will be happy.
That's
that
right.
point.
Everybody's going to be happy if you make
Everybody's
25% a year. What if you don't? What if that advisor, that 95% that's put out financial plans and retirement plans that are based on past results, even though it says everywhere, past performance is not indicative of future results, that's exactly what they're doing.
Well,
showing you that.
Let's take a literal look at what that would look like, because we're talking averages. Let's say it averages 8%, and and that's huge. It's twice what it's done. 1 year it lost 30%. Now you're still withdrawing your 6 or 7, so you didn't lose 30, you lost 37. The next year it made 20, but you're still withdrawing your 6 or 7%, so you didn't make 20. You only made 13 or 14. When you're withdrawing, when you're in the distribution phase, I can't emphasize enough, the averages change when you're withdrawing.
You cannot. I call it the death spiral. Remember, if you got $1 million, you lose 50%, and you're taking out that, say, $50,000 a year.
Right.
You're down to $450 after 1 year. Market makes 10% the next year. You still got to take 50 out. You got 400. 10%. You're back up to 44,000 or 440,000. So you can't do it. If you have any more things, it'll never recover. I don't care if it makes 15% a year forever.
And this is why we love the pension, the guaranteed income. If you've got whatever your number is, 5,000 to 50,000 a month, whatever you need, if you have that taken care of, you're not withdrawing when the market's down 20 or 30%. You're letting it go because you can. It might be for the heirs. It might be for some big expenditures, but you don't have to mess with it. In my opinion, these pensions enhance your portfolio. They allow them to grow. Tuesday of last week, the Dow hit 19,000 for the first time. It wasn't there for a half hour, 45 minutes, and one of the pundits came on and said, well, with the Trump presidency in 8 years, it's going to be at 36,000. Well, you can't say that, and you certainly can't plan your retirement on that.
No, you got to plan your retirement on what if things don't happen right.
Stress test, like
right.
you said.
You can't have, because if you can live with the worst case, you can surely live with the best case or average case, right?
Amen.
So if it does make an average return, of course you'll be fine. You'll have more. But you've got to think about it. Like we call this a common sense investing show. Does it make sense that your entire retirement is based on what the stock market does or doesn't do? In other words, if it makes your 6 or 8%, whatever that average was, even down to 4, you'll be fine. Does that make any remote sense to anyone out there? To me, they always ask me, what's a perfect retirement? Well, besides your health and family.
Exactly.
I'm talking about financially. Well, I got $10,000 a month in bills in retirement. $12,000 a month comes into my bank account every month for the rest of my life or more. Now I know the bills are paid no matter what happens to the stock market or anything else. I don't care what interest rates do or anything else. I'm going to get that $12,000 a month, which is $2,000 above my actual bills.
What if you get that $12,000 that was kind of inflation hedge, where that would $12,000 a month could go up as the market went up and not gone down? So you've got some increases like Social Security.
That's what you have to have. You have to have something that can increase if you can do it. Some people still will take the higher payment, but if you can take a little lower payment with an increasing inflation protection, it usually makes sense, especially long term. Long term is what you got to look for. Don't assume because your parents lived to a certain age that you're going to live to that or a little bit better. People keep living longer and longer. You know, they'll keep you alive when you don't want to be alive in a nursing home.
That's
just
terrible.
On and on. My stepmother they said 42 spots in her lungs. She'll never live past a year. And that was like 25 years ago.
Really?
Still smokes when she takes her oxygen mask off, smokes in between.
Oh, stepmother. I was thinking you were talking about your mom.
No.
Oh, no.
I think that's dangerous. I'm not sure. I'm not a doctor, of course, but that sounds very dangerous to me. Remember,
It'd be good.
Give us a call if you'd like any free information kits on anything you've heard on our shows or our commercials for the last, 25 years or whatever. 972-715-2424. Again, 972-715-2424. Or you can always go to ilovemyretirement.com. There's some great videos and information on there. We got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
That's right. It is based on common sense. Remember, if you break down investing to its common sense core, it's a lot easier than you think. There's still going to be some details that you have to work out with, income versus expenses and cost of living adjustments, inflation. But I'm telling you, when you start bringing stuff down to just a common sense core, it's a lot easier than you think. And that's why our philosophy makes so much sense. Does it make sense that you have to have the market make a certain percentage every year, your retirement? That's what makes your retirement last. Or, I don't care what happens to stock market or interest rates, my retirement's guaranteed to last. You just got to ask yourself that. I don't care if a broker says annuities are the devil's work. You should never touch one. Well, low-cost annuities produce more income per dollar, so it just allows you to put less in, because your restrictive piece is going to be your income-producing piece. You can't move around a bond portfolio that much, or a dividend-producing portfolio if you need consistent income. It's more consistent than those. It's higher guaranteed. So right now, with lower interest rates and a volatile market, in my opinion, it is the best way to do it. But there are other ways. We can show you the non-guaranteed route through our stock and bond program. That's up to you.
Yeah, and there's adjustments you can make, obviously. They're not enjoyable, perhaps, but they're real. One thing the financial analysis will show you is pretty much what the maximum income you can get with X amount of dollars. And we try to get everything in its proper pocket. Once you know that number, it's going to help you make other decisions like, when can I retire? You were thinking 62. Well, you're going to have to wait to 67 or 68 now with the Social Security.
So if you're over 40, it doesn't matter. Some people say about 10, 15 years. That's the best time to do this plan.
That's right. You can
do it anytime you want, but that's the best time.
You may need to look at what area you're living in. You may be in a fancy suburb. Their taxes are higher. Maybe you can move to one where taxes are a little bit lower. Maybe the house is a little bigger than what you really need, but you really like it. But
how dare you say that?
I know, but maybe a little smaller of a home is more appropriate. But once you know the number, we call it visibility. Once you've got the visibility and you know what things are going to be, maybe you need to save a little bit more to get there because you need 20% more income than what the program is showing you. Well, how much money does it take for me to get there? You'll know that, so you can add it. So you can make the adjustments and get yourself back on course.
There's a study recently that said like 75-80% of Americans don't really have an accurate idea of how much they need at retirement.
Oh,
They just don't.
I believe that.
What they think, if they saved a decent amount of money, especially if they've saved anywhere more than $500,000, they always feel they're fine.
Or whatever they get, they'll be fine. They'll make it work.
That's right. But it's not that easy. It doesn't matter what you saved or what you earned in your lifetime. It matters what you spend. And so if you're spending a certain amount in retirement, we can show you, okay, here's what you'll need to have if you want stocks. Here's what you need to have if you have CDs. If you want annuities, here's what you need to have. You make the decision for yourself. Don't hesitate to call us at 972-715-2424. We can give you an actual quote on your portfolio. Here's what you can do. 972-715-2424.
Who's the big financial advocate on the radio? His name's escaping me right now.
I can't think of it. I can't remember.
Anyway, he had a commercial on. I wanted to give him credit because it wasn't my idea. But he had a statement talking about listening to his show and everything, and I thought it was a pretty good statement. He said, the single biggest wealth-building tool you have is your job. So sometimes you need to work a little bit longer because it's a huge income compared to what you might be getting in retirement. So think about that too.
We developed this show to answer your financial questions. And so anytime we have a question that we know is going to appeal to a broader audience, whether that's phone calls from us or clients or prospective clients or whatever, we're going to share it with you. We don't ever use names to protect the innocent. All right, what's your first question, guys?
First question is, most of my money is in a retirement plan. I spoke to an advisor that explained that I should close out the retirement plan, pay the taxes now, and it sounded like a good plan. What are your thoughts?
All right. First off, anybody tells you to cash out your retirement plans and pay full tax on that thing is not a financial advisor. That is somebody trying to sell you something, because that is the worst advice I've ever heard. You cannot, they'll say it's a government plan. You know they're going to take it from you anyway. It's not your money anyway. It's the government's money. That's a bunch of load of crap. Anybody that tells you to cash out an IRA to buy a life insurance policy, to buy a piece of real estate, or anything else, I'll venture to say is either ignorant or a crook.
And
you got to be careful.
They group all of the investments and call it an IRA. I heard a commercial. I won't mention the name, Victor may, but I won't mention the name, the other day. And they said, if you have an IRA, doesn't ask where it's invested, If you have an IRA, it will go down 30%. It's just a matter of when. And then they go on to tell you to cash it out, pay the taxes, and they've got some plan, life insurance plan, where you can put your money in and draw it out tax-free. Well, the problem is if you're far enough down the road, let's say 45, 50, you don't have the time for it to accumulate and defer long enough and for that life insurance program for it to pay you as much as you want tax deferred, regardless of all the disadvantages of getting rid of the IRA.
Yeah, you got to be very careful. You should never cash out an IRA. Think about it. If you got a $500,000 IRA, remember I heard that radio show where that person was telling, "You got $1 million bucks, cash it out." Are you
was that a real
crazy?
estate deal?
Yeah, but are you nuts? That automatically puts you in the 39.5% tax bracket, and that is just craziness to lose 40% of your life savings in one day that took you your entire life to save. That's horrible advice. I don't care what anybody says, because what I saw this other commercial was saying that you put in retirement plans, you get a tax deductibility, and it goes tax deferred. Sounds good, right?
Right.
Wrong. It's bad for you. They don't know. Like I said, those are not financial advisors. If they have one credential, they need it yanked because they're not giving you good advice. If you have financial questions or like to take advantage of our no-cost, no-obligation retirement analysis, Social Security Optimizer, or just like a free information kit on the index annuities you hear about, or anything else you've heard on our shows for these decades, don't hesitate to call us at 972-715-2424. You can always go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. All right, let's just get right into it. What's your next question, Guy?
All right, next question is, I know all of you guys preach that you should delay Social Security. Besides the fact that Social Security might not be there, or I won't live that long, I have done a detailed analysis that taking Social Security early and investing the proceeds would benefit me greater than waiting. Why don't you share that with your listeners?
Okay.
There's an angry man.
Actually, I saw an article written by, I think it was Scott Burns,
Uh-huh.
and I agree with usually about 80-90%.
I was going to say 70 or 80, but okay.
Every once in a while, there's some off stuff
He
there.
gets off the reservation.
I know. He throws a couple of ultra-liberal views, in my opinion, out there that I'm not
Just
sharing.
saying.
But he's right. He's dead on this one. It's usually an engineer type. I know because I'm one. That basically has assumed some kind of return on these proceeds.
I'm thinking Monte Carlo?
Not Monte Carlo, they're just assuming.
All
I'm
right.
going to take this $1,200 instead of $1,800 Social Security. I'm going to invest that for that 5 or 6 years, right?
At a number, at 8%
That's right.
or 7%.
Usually it's
or...
6 to 10 to 12% is
All right.
you're assuming. But that's a pretty damn big assumption. And so you got to be real careful with that, because delaying Social Security, remember, it's 8% growth between all of those different issues. Plus, if you're still working, you're going to get a discount taken off the Social Security. Remember, for every until your last year before full retirement age, for every dollar you make above like $14,000 a year, for every $2, they're going to take $1 of Social Security away. It just does not make sense in most cases. I'll show our Social Security Optimizer will show you what it actually costs you in real dollars, not percentages, not hyperbolic. And also remember, typically it's a husband and wife, right?
Right.
And it's usually, if it's an engineer, it's the husband's account we're talking about a lot of times. Well, he's only thinking, hey, my parents didn't live past 80. I'm only going to get it from 67 to 80 anyway, and I'm going to invest these proceeds. But remember, it's for 2 lives, because if one of you passes away, the other one's still getting that larger Social Security. And so they're going to really be thankful that you took the larger one later. And so when you start factoring in a life expectancy of an individual, it's going to be somewhere in their 80s. When you start figuring a life expectancy of a couple, it goes up substantially. The odds are, if you get to 65 years old, a couple, there's a good chance one of you gets to 92. And that's increasing over time. So
I would
be careful with that.
I would take it a step further. If you're going to take your Social Security early, in the sole essence of that, what are you doing? You're quitting working, and you're working as your most income, and you're not only taking a lower Social Security because you're doing it early, but you're giving up that income. income probably multiples of what your Social Security is, which allows you to save and grow the retirement and a lot of other neat things.
Well, are there exceptions to the rule? Sure.
Absolutely.
Let's say you're getting $1,200 and you'd have got $2,000 if you'd have waited. But your bills are only $300 a month.
Yeah,
you live in a cardboard box and don't have any electricity.
And quality of life is the most important thing.
I get it. But for most people, trust me, when you actually do an analysis on it, on your particular Social Security statement, it'd amaze you. So call us at 972-715-2424. Go to ilovemyretirement.com if you'd like one run on you. All right, what's the next question?
Oh, this is kind of a good question. I get that rebalancing makes sense, talking about rebalancing the portfolio. But is there any way to rebalance without having to sell my best stocks and mutual funds?
Right. Well, that goes to the definition of rebalancing.
Exactly.
What happens is, let's say what rebalancing is, let's say, make it easy math. You got 5 different things you have to rebalance, growth, value, large cap, small cap, international, fixed income, whatever. What happens is some of those, let's say they're all 20% each.
Right.
But the growth stocks outperform the other ones, right? So you're having to sell the growth one that is making the most, putting it into the other allocations that are losing money or making less. It seems almost counterintuitive, but that is the case. You have to do it if you want to have an effective portfolio. Otherwise, you're the guy that ends up 90% tech stocks in 2000.
That's right, because you didn't rebalance.
You are the guy. Because what happened, they were making, 80% a year for 4 or 5 years?
And you may sell growth early and buy the poor stocks early as well, but what it's forcing you to do is sell at a high and buy at a low, in essence.
Right. It's averaging out that portfolio, because I'm telling you, just because the returns were better in one sector does not mean that you need more allocation of that particular sector. Sometimes it's just a hot sector is about to burst.
And you're still keeping your 20%. You're keeping your percentages where they need to be.
It is one of the hardest things that I have to show people is, yes, selling the one that's winning and putting it in the loser does make sense. But otherwise, you'll end up with 80% one particular hot, sector. Another thing that I have a real issue explaining to people is, let's say I've got a $2 million portfolio. Taking $500 out and creating an income stream with it, and assuming it's gone, even though we don't do anything like that, but we're assuming it's gone, will leave you more money the entire time you're living. Your heirs will get more money if you pass away, and you'll never worry about the stock market again. That is one of the hardest things ever to convince someone, because all they're thinking is, wait a minute, look, you're going to take out $500,000, and that's gone? I said, it's not really gone. Your heirs still get it and all that stuff.
Right.
But if you live long enough, it could be gone. So let's take it out of our heads. Well, that's only $1.5 million I got left. I'd like to leave $2 million to the heirs. Well, remember, it pays so much more income per dollar than any other investment out there. You might not have to touch your other investments. If they just grow at 2-3%, you're going to leave your heirs $3 million. So you'll have more money, they'll have more money, and you'll have peace of mind. Don't hesitate to call us at 972-715-2424. We can show you how in your particular portfolio. Again, 972-715-2424. I'm Victor McClure. For Guy Allert, we always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure, and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice